So you'll hear a lot of talk about trading rules and what you should do. Today's video, I'm going to kind of take a little bit of a different approach and talk about things you shouldn't do and why it's so important. Hey everyone, lead trainer with Stocks to Trade, Tim Bohen here. Be sure to subscribe and ring the alert bell. We put out a bunch of great videos every week. We also do some live videos that are timely information during the market day, after market hours. So be sure to hit that bell so that you get notified. You can catch these live, participate in the Q&A, and really engage. So, as I mentioned in the beginning, we're going to talk about things you shouldn't do. I've got 5 rules you should always follow, and they really often trip up traders. Number 1 is not learning the market. What do I mean by that? You got to have seat time, okay? We talk about that. I think that's kind of a flight simulator type idea. You know, you got to, before they let you fly a commercial plane, you got to be in the simulator. You got to put in that seat time. Kind of a meathead. I like to call it putting in reps. You know, again, if you're a runner, I hope you wouldn't go run a marathon tomorrow unless you ran a mile, ran 2 miles, ran 5 miles, put in a few months, then you take on that marathon. And one of the things I think a lot of people do is they just jump in. You know, you can start literally today. If you've got a laptop, a Wi-Fi connection, and a couple $100, no one will stop you from trading today. You could have a brokerage account, wire them money, and in 20 minutes from now, make a trade. I think that's one of the worst things to do. Put in that time. Paper trade, trade small. A lot of the times on the Steady Trade podcast, we talk about a lot of these newer traders, and a lot of the most successful newer traders, they spend 6 months, a year, 2 years, even paper trading, never even putting in that trade. So the biggest thing, don't just jump in, watch the market, learn it, review, and put in that seat time. The second thing I think a lot of traders make is not using technology, particularly the best technology. Obviously, I'm a little bit biased. I think Stocks to Trade is one of the best stock trading platforms out there. It's cosmetically awesome. I love the way it looks. It's easy to use. We've got pre-built scanners that get you up to speed immediately to find the most volatile stocks or even find swing trades and investments. We've got Oracle, a great algorithmic-based tool that lets you build a watch list of the most volatile stocks with one click. So I always say, I joke about, well, I don't really joke, I mean it. We live in the greatest time in history. I mean, every year is better. Research Steven Pinker, I believe a lot of his work is true. You know, every day it gets better. We have all this amazing technology, smartphones, super high-powered laptops, software like Stocks to Trade. Take advantage of the technology to empower you to grow your account. Third thing I see so many traders do that you should never do is writing a trading plan. I mean, if you watch these videos, and I appreciate it, you'll hear me harp about write down your plan. What is your stop loss? What is your goal? Why are you trading this stock? Entries, exits, spots on the chart, support and resistance levels, all these things we talk about, you need to do that. Now, what I see a lot of newer traders do that take those big losses, they go from having no plan, being unable to write a trade plan, to that intermediate level where they're like, okay, I'm going to commit to this. I'm going to buy at $1.50. I'm going to stop out at $1.25. My goal is $2.25. Then all of a sudden the stock's at $1. It's at 90 cents, and they're still in it. Okay, you need to move into the third phase of the trade plan and actually follow it, okay? That does 2 things. Number 1, it preserves your capital. If you're a new trader, one of the biggest, most important things you need to do is stay in the game. Preserve your capital. The other thing that really trips people up when they don't follow the trade screws you up mentally. It really, really messes with your head, because now you're staring at a big loss and you go into that self-hating mode. I've been there many times. You're like, you're an idiot. You said you'd stop out here. You're still in this. So now you're staring at a bigger loss. You're messed up mentally. What are you going to do when the next trade comes along? Or what are you going to do next day? I'm telling you, nobody wants to take a loss. I get it. But it's part of trading. But one of the most refreshing feelings is when you plan something out, it doesn't work, and you stop out where you said you would. You're losing money at that point. You're taking that loss, but it feels really good to stick to your plan. So don't break that. If you're making plans, if you're putting those stops, if you're putting those goals in, don't get greedy either. Stick to your plan, and it will help your psyche and help your account. Fourth one, and I'm going to keep it quick because it's such a simple thing. Please don't let your stop losses run. Please don't take a bigger loss than you said you would. If you've got a small account and you said, I'm going to lose $100 on this trade, stop out at $100. Because remember, if those losses grow, you got to make double just to get back to where you were. Okay, if you were going to lose 100 and you lose 200, now you got to make 200 just to get back to break even. Please, it's the most critical thing. Cut those losses early. The fifth thing I see so many traders doing is risking too much, okay? We see this a lot, particularly on the short side. I see so many newer traders that get enamored with short selling these high flyers, and I actually posted a meme to my Twitter the other day. It's this funny meme of this kid making all these faces in the progression. He's down 500, then he's down 50, and then he makes 10 bucks and he's celebrating, okay? That is not trading. That is not risk management. If you're risking $500, you take a $500 drawdown and then you make $10, you will not be successful over time, okay? You profited. You might be like, well, Tim, I made 10 bucks on this trade, but if you're risking 500 to make 10, you will not be successful over time. You will blow up, okay? Have proper risk management. If you look at this trade and you think, okay, I'm hoping to make 100, then you never want to risk more than 3-to-1 ratio, okay? If your goal is to make $100 on this day trade, in and out in 10 minutes, whatever it is, you should be risking $33 with commissions, okay? That's a tight stop loss. But as you grow, maybe you're risking 1,000. Now you're risking 300. Focus on that 3-to-1 risk to reward, and don't take those terrible drawdowns. It's not going to work over time. Thanks again, everyone. What I would like to know in the comments is, have you broke these rules? Give me a comment below. Do you break these? Are you still breaking these rules? Hey, something about trading is nobody's ever perfect. We make mistakes over and over and over again, but we focus on minimizing those mistakes. Thanks for watching our video. Be sure to comment below with any trading related question. We love answering your questions. Also, like and share with your friends, and be sure to subscribe to be notified as soon as our next video hits. And if you're looking to expand your trading knowledge, don't forget to check out all of our other videos, and be sure to click the trial below. Check out StocksToTrade. I think it is one of the best, most rapidly advancing softwares out there. Be sure to check out our trial.